welcome back to my channel. So today's video will be all about fair value gaps. I'll discuss how they function, how to identify them, and the structural benefits of how you can use them in your trading. So to start, I'll break down the definition. Then in the second half of this video, I'll dive into Thinkorswim to show examples of what this looks like on the chart. Everything is already timestamped, so you can be sure to check it out in the description. So let's go ahead and get started. So to provide the basic definition of a fair value gap, is simply an imbalance where the price has moved rapidly in a direction, which then leaves a lack of an overlap between the wicks of candles in a 3-candle sequence. And the reason why this is important is because there's an imbalance that is created and the price may return to fill this gap. So if we look at the bullish fair value gap here on the screen on the left, we see a sequence of 3 candles. The first one being bearish, the second and third are bullish. At the high of the first candle and the low of the third candle, it presents a void in the middle of them, since there's no overlap, therefore creating a gap. Now you'll see examples of this on larger time frames and even on smaller time frames. You can spot market imbalances where buyers and sellers dominate, and it creates again those price gaps. Now when we look on the right side of the screen, we see the bearish fair value gap. It functions the same way as the bullish FVG, but in the opposite direction. Essentially, the space of the gap is filled in where the wicks do not overlap from the first candle's low, which is a bullish candle in this case in the sequence, to the third candle's high, which is a bearish candle. Now, some traders watch for the price to retrace into the fair value gap zone, and they view it as an opportunity to trade back to equilibrium. And basically, that just means that the market is correcting itself. Now, on small time frames, this can be useful to spot moments where the price is likely to fill the gap before continuing its trend. Now, I do want to mention that there is a such thing as an invalid fair value gap and an inverse fair value gap, and we'll talk about that when we dive into TOS. But to continue on, let's break down these two examples in a little more detail so that it makes perfect sense. Okay, so now to provide an illustration of a bullish fair value gap, you'll see here the 3 candles in sequence. The first candle being bearish, it closed at $99 and reached a high of $102. The second candle opened at $99.50 and it fell slightly to $98.50, but then buyers pushed the price back up and it closed at $104. The third candle opened at $104.20, with the high reaching $108, the low being $103.50, and it ultimately closed at $107. So the fair value gap is the space between the high of the first candle at $102 and the low of the third candle at $103.50. This creates a $1.50 gap, signaling a bullish imbalance. This suggests a potential zone where the price could retrace before continuing to rally higher, and traders might watch this area for signs of support, expecting the price to eventually move upward after filling the gap, which is usually significant in high-frequency times, especially in momentum-based trading. And you can use this benchmark in some cases for an entry point to go long. Okay, so now providing the illustration of the bearish fair value gap, you'll see here it's still 3 candles in the sequence. The first candle is bullish with the closing price at $102 and a low of $99. The second candle opens up at $101.20. It drops to $95.50. It then wicks above $102 at the high and then closes at $96. The third candle opens up at $96.50 and then it drops to close at $94. So in this case, the fair value gap forms between the low of the first candle at $99 and the high of the third candle at $97.50, therefore creating a $1.50 gap. Now again, this $1.50 bearish fair value gap suggests that the price is actually not level, and this could act as a point of resistance. And if the price retraces to this level, traders can watch for signs of a rejection, hinting at the projection of the continued downward movement. So hopefully this is all making sense so far. Alright, so the last thing to note on this before we get into Thinkorswim is that the function of fair value gaps provide a means of analysis of price action. So all in all, you can use them to help anticipate the next move. One way to view them for your trading strategy is to look at directional trades. When the stock or ETF's price returns to a fair value gap, and then it resumes its previous direction, it can signal a potential trade setup for buying calls or puts, and you can also analyze FVGs for breakout trading, because fair value gaps often form as strong price moves. So if the price retraces and then continues in that same direction, it can present a solid opportunity for placing your entry on a trade. You'll also notice that the functionality is good for identifying support and resistance levels. Specifically, unfilled FVGs may act as zones where price movement slows or reverses, making them valuable for timing their entries, specifically in like certain spread strategies. And then lastly, fair value gaps can provide clarity within volatility and momentum. So FVGs can also indicate potential spikes in volatility or high movement, which may impact the pricing of options, especially those nearing expiration. So that's a good thing to keep in mind. So for the most part, y'all, using FVGs to analyze market structure can help your options trading strategies and improve your decision making just based solely on price action. All right, so now that we know how it works and how it functions, let's go ahead and dive into TOS. Okay, so now that I'm in TOS, you can see I have CrowdStrike pulled up here on the daily time frame. So I'm going to just go ahead and zoom it in just so we have full context. Now, the very first thing I want to discuss is what a fair value gap is not. So I want to make sure it's very clear so you guys can see that there must be some sort of validation in this. So in order to do that, let's go ahead and take a look at a few sequences of candles. We're going to go ahead and start with these three here, December 10th, December 11th, and December 12th. Now this first candle here in the sequence is a bearish candle, and we can see that the high reached 357. And then when we look at the third candle in the sequence, we can see that this is a bullish candle and its low reached 357. So if we were to chart for this, essentially for the price level, this would also show us that these two candles here have no gap in the middle of them. So in this case, this would not be considered a fair value gap. Reason being is because the first candle in this specific sequence is actually going to have the height at the equivalent price level of the low of the third candle in the sequence here. So if we don't have any room for a gap, then it essentially cannot be a fair value gap. Now I know this may be common sense for some, but I have had this question asked to me before. Is it possible for the levels to be kind of equal or somewhat equal? And the answer is no. In order for it to be a fair value gap, there has to be some distance or some space, and essentially that's usually created by the length of the middle candle. If that body is really stretched and long, that's essentially what's going to give you the room for a gap. So yeah, I just wanted to pinpoint this so you understand fully on what a fair value gap is not. Okay, so moving on, let's go ahead and take a look at what some fair value gaps would be that are valid. I'm going to go ahead and pull up Starbucks, and let's take a look at it on the 3-year, the weekly. All right, I'm going to go ahead and zoom it in just a little bit so we can get full viewpoint. And now we're going to go ahead and start by looking at a bearish fair value gap. So we'll look at this sequence of candles here from August 7th, August 14th, and then August 21st. So these three right here. So if we look at this first candle's low as far as the wick, we can see it at about $99. And then if we look at this candle's high here as the top wick, we can see it at about $97, therefore creating the gap between the two. Now we don't see any type of bearish engulfing, bullish engulfing to start before the sequence of candles, so this would be fine and fair. However, I will say that this is a moderate fair value gap in the sense that there wasn't a strong push to the downside. We can see that this bullish candle here actually closed within the gap. We can see that it also wicked above, which is completely fine as well. But this was not a strong momentum of a push. It did follow the rules, and it is considered a valid fair value gap because the stock did fall into a further downtrend. However, my point in showing this is that it was not a strong trend based on the sell-off. We can see that it was a fairly weak trend essentially. Now, if you're new to trading, you may be asking yourself, well, how do you know that? How do you know it was a weak trend just based on these candles? I also have the ADX pulled up here on the chart. You guys can see this red line here, and the ADX will tell you the strength of a trend. So I'm intentionally showing you that this specific fair value gap is in fact a quality one in terms of being valid. So it will provide the basic definition and structure of what it is. However, you can see that the ADX is in the range of like 12 to 13 for these few weeks, which essentially is going to tell us that the trend is not going to be strong at all. Now, as mentioned, I'm intentionally showcasing these types of fair value gaps because it's so obvious and it's easy to spot the ones that have strong trends, but a lot of people don't know exactly how to spot the ones that have moderate or weak trends. You always want to make sure you look at it from all contexts. That way you have full understanding. Okay, so this was the example of the bearish one. Let me go ahead and pull up a bullish example, and we're going to look at Amazon, and we'll actually pull this up on the daily, and I'll go ahead and zoom it in just a little bit, and I'm gonna slide it over just a little bit as well. Okay, so now we're gonna go ahead and take a look at this three sequence of candles, November 15th, November 16th, and November 17th. So these three bullish candles here. Now we can see that the high of this candle reached about the $200 mark here, and we can see that it created a gap to the low of the third candle here at about 207. Now this is also considered a valid fair value gap. We don't see any type of engulfing prior to it. And then we also can see that the candles that followed we see that this bearish candle kind of touched briefly on the top level of it, and then this bearish candle actually closed within the gap. And that just simply adds confirmation. So when we see that the stock rallied back up to the upside, although very brief, it still was a valid fair value gap. Now I know, again, this is small momentum, and I'm displaying these smaller moves simply to display that the momentum will not always be long-lived. Although you may see a long body candle and those are easier to recognize, again, when you see these smaller ones, sometimes institutional investors use these tactics and strategies. So it's important to understand essentially what you're looking at. We do see that this fair value gap is validated, and it did rally to the upside briefly, but it was not long-lived because we saw that the stock fell back into a downtrend. So why this is so important is that you definitely want to make sure that when you're analyzing the charts, you don't have unrealistic expectations of what the stock will do when it falls into these fair value gaps. And strategically, all you're really doing is waiting for the market to correct itself following a pullback, hence the retracement here, and then you're waiting for it to rally to the upside if it's bullish. And then on the bearish side, you're waiting for the exact opposite. You're waiting for that pullback, and then you're waiting for the stock to actually fall further into a downtrend. My whole point in saying this is that it may not always be super significant. I know we like to glamorize it and make it look like this is going to be a strong push to the upside or a significant drop off to the downside, but sometimes that sell-off isn't always as strong, and sometimes that rally to the top isn't always as powerful either. Now we can see the ADX in the range of about 20 here, so we can see that this specific trend is higher than that bearish one I just showed you as an example, but still not a very dominant trend. However, there is confluence when we look at the fact that it fell back into the gap and then it rose back up higher as far as the rally to the top. So this shows that the strength of the ADX rose as the stock actually rose up as well. So again, this would not have been a terrible setup, but my whole point in making this video is that the fair value gaps don't have to be super long and strong either. So I hope all of this makes sense. Now I am analyzing these candles on a larger time frame. You guys can see I've been using the daily and the weekly, but it is important to know that fair value gaps can absolutely happen on smaller time frames like the 1 minute, 5 minute, or even like 15 minutes. These gaps are not restricted to daily or higher time frames. I just want to make sure that's clear. They can appear on any chart depending on the market conditions and of course price action. So on smaller time frames, essentially how it works is the lower the time frame, price action moves more frequently and the candles are typically smaller. A fair value gap might form within pennies or cents, making it harder to spot, but it's still significant if you're trading in those time scales. So with the market being unleveled in a sense, even on smaller time frames, those market imbalances where buyers and sellers are competing, it can create those price gaps. Now, liquidity also plays a huge role in this as well. So in low liquidity markets or during like news events or any types of announcements, gaps can appear on any time frame as well. And the opposite is also true. For instance, in like fast moving markets, a quick gap up or down, it can occur, leaving a void between the close of one candle and the open of the next. This is also likely identified in after hours and pre-market, which is why anytime you see me do those scalps and I'm trading at the very start before the market opens, I'm always taking a look at what's going on prior to. So if you're looking at a short time frame and there is some after hours or pre-market trading happening, those price movements during those hours definitely influence how the market opens for the next short-term time frame candle, creating a gap sometimes, or sometimes it does not. So I bring this up just to talk about the opportunities. So traders who scalp on the smaller time frames, they might use those gaps to find the short-term entry or exit points. And then some traders watch for a means of reversion. So this basically is when they look for the price to retrace into the fair value gap. And they view it as an opportunity for the stock to return back to equilibrium, which is basically like leveling out and balancing itself out. Just keep in mind that the gaps can occur more frequently due to short-term price volatility, and traders can take advantage of them as a part of their strategy. So overall, the principles of price imbalance within price action, they still apply regardless of the time frame you're trading on. The only difference is the scale of which the gaps appear, but just keep in mind that it does not always have to be a super strong push. And regardless of the time frame, all can be leveraged for short or long-term trades. So yeah, y'all, I hope everything makes sense that I've discussed so far. I know this is kind of a lot of information at once. I definitely wanted to make sure I made this video so that there was not any confusion on fair value gaps and how they work and function. But that'll pretty much do it for this video. If you found any of the information to be helpful, feel free to leave me a comment down below. I thank y'all so much for watching, and as always, I'll see y'all in my next one.